Hello, Jayson here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. No, this isn't one of those clickbait headlines that promise to share one weird trick or proclaim you'll never believe what happened next. Well, actually, some people might have a hard time believing this one. In the interest of respecting the time of those who are already up to speed on last week's economic data and interest rate movements, I'm about to talk about the paradoxical drop in rates despite the recent spike in inflation. Inflation is one of the mortal enemies of interest rates, and here's why. Rates are determined by the amount of money investors are willing to pay for bonds/loans. Basically, investors give you a big chunk of cash and you make payments with interest over time. Inflation makes dollars less valuable, or said another way, it makes stuff cost more. But the value of your stream of monthly payments never gets bigger because it was agreed upon up front. As such, inflation makes your monthly payments less valuable over time or less capable of buying stuff. Therefore, if investors sees the inflation is increasing, they might raise rates today in order to realize a similar value from your stream of payments. To take this example to the extreme, let's say I loan you $100 and you make 11 payments of $10. I take each $10 payment and treat myself to 3 taco combo at the taco truck once a month. Now let's say due to inflation, the taco truck raises prices to $15. I have two choices. I can either get the 2 taco combo, and who wants to do that, or I can raise the interest rate on your loan such that the new monthly payment is $15. While it may or may not be driven by an insatiable lust for affordable tacos, it's exactly this dynamic that accounts for the long-standing correlation between inflation and rates. Granted, inflation isn't the only concern for rates, but it's always a consideration. The following chart shows the 10-year Treasury yield, the most popular benchmark for longer-term interest rates, and the core consumer prices, the most popular measure of consumer-level inflation. Actually, the most recent data is missing from the previous chart. Last week brought a new installment of the Monthly Consumer Price Index, CPI. Much like last month's report, it was a shocker both in terms of how high the number was in outright terms and compared to expectations. You'd expect interest rates to pay at least some sort of attention to such things, and you'd be right. But the attention was both minimal and temporary. The next chart shows how 10-year Treasury yields traded moment to moment last week. They did, in fact, pop higher right when the inflation data came out, but that didn't last very long. While the average news headline suggests this wasn't enough inflation to derail the Fed's low-rate policies, the actual motivation is far more esoteric. It has to do with the imbalance of trading positions in the bond market and the subsequent exploitation of or punishment of that imbalance. In market jargon, it's known as a short squeeze. It happens when a majority of traders are betting on higher rates. They make those bets by shorting bonds. Shorting involves selling at today's prices and buying back in the future at lower prices. As a side note, prices and yields rates move in opposite directions, so lower prices equal lower yields/rates. If prices rise instead of fall, there's a certain line in the sand at which those traders will buy bonds to close out their position and avoid further losses. In doing so, they are only driving prices higher or rates lower, likely forcing short sellers to cover their losses by buying bonds. Call it a domino effect, a snowball, or a short squeeze. It all adds up to lower rates, which happened in the bond market. Well, it's obvious, don't you know? COVID numbers continue to fall. The economy continues to reopen. The Fed is increasingly thought to be considering tapering its bond purchases. And the list goes on. Indeed, if we examine economic fundamentals, there are better cases to be made for rising rates versus falling rates. Just one problem, though. Everyone knew these fundamentals since the beginning of 2021, and much of the logical rate spike occurred in anticipation of the economic reality we're now witnessing. Moreover, the economy is still experiencing lots of growing pains as it heads towards wherever it's going to be post-COVID. We won't have a clear picture of that destination until this fall, according to the Fed. That makes lower rates a classic contrarian trade at the moment. No one knows. Rates are capable of moving lower from here, but probably not exceptionally lower without some new unforeseen shock. Rates are also capable of moving higher, but there too, probably not exceptionally higher until we get a clear picture and indication that the economy has shifted into a higher gear on a more sustainable basis. When that happens, or even if it looks like it's going to happen, that's when we're more likely to hear the Fed say they're planning on tapering bond purchases. That won't be happening this week, but we could nonetheless see some volatility in rates after this Wednesday's or tomorrow's Fed announcement. This is one of 4 Fed announcements that is accompanied by updated forecasts from the Fed members. Between that and Fed Chair Powell's press conference, the Fed could send some sort of tapering message without actually putting it in writing. One other wild card to keep in mind is the increased discussion among Fed members about the role their bond buying plays in real estate valuations. If they conclude that home price appreciation needs some help cooling down, they could adjust the balance of their purchases in favor of treasuries. That's a long shot for this week's meeting, but if Powell speaks to it during the press conference, it would likely be bad for mortgage rates. The press conference begins at 2:30 Eastern Time this Wednesday or tomorrow, so stay tuned for that. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.